Hello learners, I hope you are learning the things. Today we will begin with the new topic, cost of capital. As you know, in case of a joint stock company, capital can be bifurcated into two parts: owners capital, that is equity share capital and the retained earning belonging to equity shareholders, and second part is borrowed capital, that is loan, debentures or bonds. In between we have preference share capital, which we can say although it falls into owners capital category, but yes, on preference share capital company has a promise to pay fixed dividend subject to the availability of profit. Therefore, we might keep it under owners capital or we might keep in between owners capital and borrowed capital. Now today's topic is cost of capital. As you know, whenever we use the capital, whether it is owners capital or borrowed capital, we have some kind of obligation, either direct or indirect, to meet the expenses, to meet the payment related to the use of capital. If I take an example of a loan, let us assume that a company has taken a loan on which it has to pay 10% interest year on year till its maturity period of, let us say, 5 years. Now whatever may be the total amount, but every year 10% is the direct cost to be paid by the company. Apart from that, we have another cost which is also the direct cost, flotation cost. By flotation cost we mean the cost incurred by the company at the time of issuing the shares, debentures or at the time of raising the loan. This might include taking some legal clearance, taking some procedural activities, or spending money for the advertisement of the IPO, FPO or other expenses like brokerage or underwriting commission. So all those expenses collectively are called as flotation cost. So flotation cost means cost incurred by the company at the time of raising the funds, either by taking a loan from a bank or by coming out with the public issue or private placement of securities in the market. So those are the direct costs. So let us begin with the topic cost of capital. Cost of capital is the minimum rate of return that a firm must earn on its investment so as to leave the market price of shares unchanged. That simply implies that if a company has borrowed loan from a company or taken a loan from a bank or other company also, because one company can take loan from other company also. So saying that intercompany loan is also possible, or a company can take a loan from a bank or financial institution, or company can issue the debentures or bonds in the market. Now if suppose company has a promise to pay or obligation to pay 10% interest, that means to say on its investment projects company must earn minimum 10% return so as to meet the interest payment obligation and leave the equity share prices unchanged. So appropriate definition of cost of capital is minimum rate of return that must be generated on different investment projects so as to leave the equity share prices unchanged. It is also referred as cutoff rate, target rate, discount rate or hurdle rate, because this is the minimum rate which company must earn on its investment projects. Now what are the primary long-term sources of funds? Because that was the definition of cost of capital and we will calculate that also. Now one thing I should remind you, whenever we say cost of capital, we are not referring to the absolute amount of rupee, or rupee terms is not referred, it is percentage. If company has borrowed some loan, it may be of any value. Whenever we refer to the cost, we are saying how much percentage is the cost. Primary long-term sources of funds are debt, that is a loan, debenture or bonds, preference shares, equity share capital and retained earning. So in this lesson, we will be focusing cost of calculation for debentures and preference shares. In the next lesson, we will learn about calculation of cost of equity share capital and retained earning. And then third lesson, which is devoted to cost of capital, that will be about weighted average cost of capital. So first 3 lessons are on the conceptual part as well as quantitative parts on these 3 topics. Then subsequent 2 lessons on cost of capital will be about the practice on calculation of cost of capital, that means specific cost as well as overall cost of capital. When I say specific cost of capital, it means we are referring to cost of either debt, cost of preference share capital, equity share capital or retained earning. That means cost of one particular source of capital is called as specific cost. Whereas when collectively a company has used more than one source and we are referring to the combined cost of all those sources of capital, that is referred as overall cost of capital or weighted average cost of capital. Now at this point of time, it is appropriate to explain the meaning of capital structure. By capital structure, we mean composition of long-term sources of funds used by a company to finance its activities, to finance its investment projects or to finance its assets. So either a company may be purely financed by equity. Whenever a company is purely financed, that means it has issued all the equity shares, there is no borrowing, no preference shares, we say company is unleveraged company. So one definition generally comes, unleveraged company is the one, or unleveraged firm is the one in which all the capital has been contributed by owners, either in the form of equity share capital or in the form of retained earning, because retained earning also belongs to equity shareholders. So such firm will be referred as a unlevered firm, whereas there is something called as leveraged firm or levered firm. A levered firm is the one in which company has used along with the equity and retained earning either the debt or preference or both of these. So a capital structure in which along with equity shareholders funds, company has used debentures or preference shares. Such kind of company is called as leveraged firm or levered firm. So let us begin further for the calculation of specific cost of debentures and preference shares. Now, before calculating those costs, we have two basic assumptions. Whenever anyone who is calculating cost of capital or who is financing the projects of the company, he always looks at the two assumptions, whether company will be able to operate in the market or not, and what is the financial structure of the company. And those two aspects result into operating risk and the financial risk. By operating risk, we means whether company will be successfully selling enough goods and services so as to generate sufficient operating income to survive or to meet its interest payment obligation and the preference dividend payment obligation. Apart from that, it must earn sufficient operating income so as to leave something as a reward for the equity shareholders also. So operating risk is measured in terms of operating leverage, which simply indicates what is the volatility or how far operating income might change with the changes in sales value. Higher the operating leverage, higher will be the risk. Lower the operating leverage, lower will be the risk. So one thing we refer to the things, if a company is having high operating leverage, then definitely the bondholders who are buying the bonds or the money lenders who are ready to lend the money, they will charge more rate of interest because high risk requires high reward. Similarly, financial risk. Financial risk originates from the capital structure of a company. Generally, for a leveraged company which has used loan or debentures in its capital structure, financial risk is more and there is a more probability of return. In that case, even the bondholders are expecting more interest as well as equity shareholders who are assuming more risk. They are also expecting more return from their equity investment. So that kind of risk originates from the capital structure of the company. And financial risk is measured in terms of financial leverage. Financial leverage indicates the volatility of earning per share of the company towards given changes in operating income. Then with reference to the calculation of cost of capital, we have two basic terms, explicit cost and implicit cost. Explicit cost is the direct cost which a company is paying. Like if we assume a company has taken a loan from a bank on which it has an interest payment obligation of 14%, 14%, then we say explicit cost is 14%. And at the same time, company might incur some flotation cost also. Now, what is flotation cost? Flotation cost is the cost incurred by the company at the time of raising the loan or at the time of issuing the securities in the market. Like it may be expenses on marketing of the issue, brokerage payment, underwriting commission, or some legal fee to be paid by the company. All those expenses clubbed together are referred as flotation cost. So, interest payment, dividend payment, and flotation cost are the explicit cost. Explicit cost is such discount rate at which present value of cash flows inflow equates with the present value of cash outflow related to a particular source of capital. Whereas another term, implicit cost, it is not out of the pocket cost, instead it is the opportunity cost of a particular source of capital. Now, by opportunity cost of capital, we mean the quantum or percentage of benefits foregone from the second best alternate. Let us assume a company has got a retained earning of 100 crore rupees. Now, this retained earning of 100 crore rupees, one avenue may be there that company can repay its loan, or another avenue may be there, company can create an investment in the bank or financial institution where it can earn 9% return. However, instead of investing in that particular bank or financial institution, company is going to invest the same 100 crore rupees in some investment project. So, we will say implicit cost of that 100 crore is the benefits foregone from not making the investment in bank or financial institution, that is 9%. So, it is not out of pocket, but in an implied manner it is the benefit foregone from the second best alternate, that is called as implicit cost or opportunity cost of capital. Then measurement of specific costs. So, we will be talking about specific cost of debt, preference share capital, equity share capital, and the retained earning. Cost of debt. Cost of debt is the after-tax cost of long-term funds through borrowing. It is represented as either before tax or after tax. Although I have used word after tax. Now, what is the meaning of after tax cost? That means if a company has taken a loan, the interest paid on the loan qualifies for the tax exemption, or it is called as tax deductible expense. Therefore, when we will be calculating cost of loan or debt, we will always have two terms, cost before tax. That means such cost of debt where tax benefits associated with the interest payment and the flotation cost have not been considered. Whereas after tax cost is after considering the tax benefit associated with the interest payment and the flotation cost, or all the other costs associated with the debentures. So, in practice, more commonly used cost for the debentures is after tax cost. So, the general meaning of cost of debt is simple, that such discount rate at which inflow associated with the debentures equate with the present value of outflow associated with the debenture. Now, you might be thinking, what are the inflow and outflow related to debentures? So, let us take an example. Let us say a company had issued debentures of 100 crore rupees. So, company will get 100 crore rupees from the public who buy the debentures, and company has incurred a flotation cost of 2 crore. So, what is the net proceeds with the company? 98 crore. Because 100 crore rupees of debentures have been issued to public, and public has paid 100 crore rupees to the company. And while issuing the debentures, company incurred 2 crore rupees flotation cost. So, net issue proceeds is 98 crores. So, we can call it as IP, that is issue proceeds or net issue proceeds. Now, every year company has an obligation to pay interest on the face value, let us say 12%. It means 12 crore rupees will be paid as interest year on year till the maturity. And at the end of the maturity period, company has the obligation to repay the principal amount at least. It might pay more, it might pay different amount, that depends upon the terms and condition of the debentures. So, let us assume company will pay 100 crore rupees back at the end of third year. This simply implies that now we can see for 3 years company will keep on paying 12 crore rupees. 12 crore, 12 crore and 12 crore in the year 1, 2 and 3. So that is the year and that is the interest payment. Apart from the interest, in third year company will pay back 100 crore. And now what is the inflow for the company? Inflow for the company is 98 crore rupees received at 0 time, and outflow are in these 3 terms. Now we can simply say a discount rate which equates the present value of those outflow with the 98 crore received right now is called as cost of debt, and that will be before tax. Why it is before tax? Because we have not considered tax exemption or tax benefit associated with the interest payment and the flotation cost. So this simply means, let us assume, by hypothesis I am saying this particular discount rate happens to be 12.15%. That means to say at 12.15% discount rate, present value of all these future cash outflow becomes equal to 98 crore. Then we will say before tax cost of this debt is 12.15%. So simple meaning is that for the issue of 100 crore rupees of debenture, before tax cost is 12.15% of 100 crore year on year till 3 years. Then further let us assume company is paying 30% tax on its income, because every company is liable to pay the taxes. So how do we convert that before tax cost into after tax cost? So it will be simply before tax cost of 12.15 multiplied with 1 minus tax rate. The formula will come in the subsequent slide also. So now how much we get it? 12.15 multiplied with 0.7, that is 1 minus 0.3 becomes 0.7. So we get it 8.51%. It means we can say after tax cost of this bond or debenture is 8.51%. Now how these costs are calculated? Formula will be there, mechanism will be there, but that is the conceptual part I have explained to you. Particularly, so that was the simple meaning of cost of debt. Now we proceed further. There are 2 types of debts primarily issued, that is redeemable debt or perpetual. However, we might have convertible debt also. So we will see that also. So let us proceed further for calculating cost of redeemable debt. Redeemable debt. This type of debt has the following features. Firm receives net issue proceeds, that is issue price minus flotation cost. Firm pays interest at regular interval, generally every year till the maturity period. And on maturity date, firm pays back at least the principal amount or the par value. However, there may be a provision to redeem the debentures at a premium. Now, whether it will be redeemed at premium or at par, everything will be specified when company is issuing the bonds or debentures. Now, in case of redeemable debt, as we have seen inflow and outflow associated with the redeemable debt in the previous slide or in the previous session, 1 minute ago lesson, then how do we calculate cost of debt before tax? Now there is one formula approach, although we can use IRR approach also, which I explained 2 minutes ago, internal rate of return. IRR stands for internal rate of return. So that was simply a discount rate at which present value of outflow associated with the bonds becomes equal to the present value of net proceeds of the bonds. As we have seen in the previous slide, 98 million of net proceeds becomes equal to the present value of those 3 cash outflow, 12 million, 12 million and 112 million. And we hypothesize that discount rate happens to be 12.15%. But that formula or that method is lengthy method. That method is lengthy method. So generally we prescribe using this particular formula to calculate cost of debt. And all the parameters of the debt are self-explanatory, which are depicted on this slide. So this is the way we can calculate before tax cost of debt by applying this formula, and the same before tax cost can be converted into after tax cost as well by using the formula. TC stands for corporate tax rate. So that is the handy formula, everywhere it is applicable and commonly used by everyone in the market as well as in the finance industry. So let us proceed further by solving an example on that one. If we take this example, 9% rupees 100 debentures. So 9% in this case is the rate of interest or coupon rate. 100 is the par value issued at par. Now one thing I should remind you, if in the examination question or in a theoretical life, we are not given how the debentures are being issued, whether these are being issued at par or at a premium or at discount. That means question is silent about the issue price. Then normal consideration or default consideration is that these will at least be issued at par. Similarly, if in an examination question is silent about the maturity value or redemption value, then generally we assume that these will be redeemed at least at par. So if question is silent about the issue price, assume the issue price equal to par value. If question is silent about maturity value, then also assume maturity is at par. Now in this case it is specifically mentioned. So we have issue price 100, provision for redemption at 5% premium. That means maturity value will be 105. After how many years? 5 years. So N is 5. 9% is the coupon rate. So every year interest will be paid rupees 9 for 5 years, and company has incurred 6% flotation cost. So flotation cost is rupees 6 per debenture. Now what we get P? P is simply issue price minus flotation cost. So debentures have been issued at 100, 6 is the flotation cost, so 94 is the P. Now we can use that formula. Cost of debt before tax or pre-tax is interest, which is 9 in this case, plus maturity value, which is 105, minus P, which is 94, divided by 5. 105, that is maturity value, plus P, an average of that. Now if you see this particular calculation, how it will move about. So you can see it is 9 plus gap between 105 and 94 is 11. So 11 divided by 5. An average of these two. So 105 plus 94 divided by 2. We get it 99.5. So how much we get it? 9 plus 11 divided by 5, we get it 2.2 divided by 99.5. So ultimately we get it 11.2 divided by 99.5. So we get it 0.1126. That makes it 11.26%. So by looking at the debentures, we find that it is 9% debenture. But effectively, due to the impact of flotation cost and the impact of redemption premium, cost gets escalated. Cost increases to 11.26%. That means on the total funds which company will be using by issuing these debentures is completely, every year company is paying a cost of 11.26% for a period of 5 years. So that is before tax cost. Now the same before tax cost can be converted into after tax cost. Now formula is handy for the after tax cost. So KD post tax is simply KD stands for cost of debt, pre-tax multiplied by 1 minus TC. So 11.26 was pre-tax cost, tax rate is 30%, so 1 minus 0.30, so what we get 11.26 multiplied by 0.70. So 11.26 multiplied by 0.7, we get it 7.88%. That means after tax cost or post tax cost is 7.87%. So that is the way we calculate after tax cost of debentures. Let us proceed further. So that was the question in which debentures were issued at par. Now let us take another example. Debentures are being issued at premium. 12% rupees 200 debentures issued at 3% premium, having a provision for redemption at 7% premium at the end of 4th year. The flotation cost is 3%, and if tax rate is 30%, then calculate after tax cost of debt. So how do we calculate it? 12% is the coupon rate. 12% is the coupon rate. So we take it like this. Interest payment will be 12% of the par value. So just pay the attention, par value is 200 in this case. So 12% of this, 24. Issue price, 200 is the par value and 3% premium. So 3% of 200 will be calculated, 206. Then maturity value. Maturity value, 7% premium on 200. So 200 is par value, 7% of that, 214. And then N is 4 years. Flotation cost, what we have with us, is 3%. 200 minus 6. So by chance this 3% and this 3% are the same, but never get confused. And TC with us is 30%. So these are the basic parameters I have written for your reference to plug into the formula and get the answer. Now always remember, this is the way parameters have to be calculated. So in the next slide, we will see about the preference share capital and the equity share capital. Thank you for letting me your time. Thank you.